Welcome to Better Today with Alex Merced, where we talk about improving your life by working on your relationships, knowledge, skills, and health, by allocating your time to development, maintenance, and leisure of those things. If you enjoy the show, please consider becoming a patron at patreon.com/AlexMerced. Hey everybody, this is Alex Merced, and welcome back to the Bitcoin Blockchain Crypto Podcast. And we're going to continue our conversation about ETFs. If you didn't listen to last week's episode where we talked about what is an ETF, today we're going to talk about why an ETF is sort of important to an asset's price, or how it can affect an asset's price. So let's talk a little bit more about what happens when you create an ETF around something. So there's ETF, exchange traded funds, around pretty much every asset you can think of. So let's imagine, actually we'll just use a real world example. That's GLD. That's the gold ETF. There's GLD, which is gold, and SLV, which is a silver. So traditionally, if you wanted to buy a gold as an investment, you would have to buy actual gold. You buy gold coins, or you'd go through a gold dealer. You may be able to do gold futures. Gold futures can be very volatile. You can lose a lot of money really quick through small price changes. And buying gold directly, oftentimes dealers charge you abnormal, huge markups, because just the sort of that side of the industry isn't as regulated. So you have dealers who charge you reasonable markups and are, above board, but they don't necessarily spend as much money on advertising as dealers who charge you much higher markups and try to push you towards sort of collectible coins instead of just pure bullion, where again you're speculating a little bit more and you're taking a little bit more risk because you're hoping that the collector's value will continue, which means you better hope there's still coin collectors in the future. So that was the problem. So a lot of people never wanted to expose themselves to gold in that manner. Enter the GLD ETF. Made it easy. It was having exposure in your portfolio to gold was easy as buying a stock. Now, as people bought the GLD ETF, the price of the GLD ETF would go up. And again, just talking about how ETFs work, again, ETFs are kind of like a weird in-between between open and closed-end funds, where you can make more shares if you buy them in big blocks. Otherwise, the shares trade like a stock. So as the GLD price would go up and go above the net asset value, so basically you were paying more for a share of GLD than you would be paying for the value of gold, institutions would arbitrage that, get new shares of GLD made at the value of gold, and then sell them in the market at the higher price. So that would keep introducing new assets into the GLD portfolio, which is then used to buy more actual gold. So the actual portfolio of GLD, of the actual gold that the GLD fund owns, kept growing as more and more people kept buying the GLD asset. And the problem is, well, not a problem, but the effect is, long as those people own those ETFs, that gold just kind of stays outside of the broader market. So people who are buying gold sort of outside of the GLD ETF, or even within the GLD ETF, because in the GLD they keep buying up more gold, it sort of shrinks the supply of available gold in the market, driving up its value more and more as investors hold it to have exposure in their portfolio. Again, not a bad thing, it's just the reality of supply and demand. You've made it easier for people to buy gold, so more people will buy gold, driving up the price of gold. Okay? So people always point out this chart where, after the existence of the GLD ETF, you see this huge increase in the price of gold. Different people can attribute different things to that. So again, is it that the exact reason? Maybe, maybe not. There might be a correlation. And there was other things that were going on at the time, whether it be sort of the financial crisis that might have scared people to buy gold as a hedge on a declining economy. There are other reasons that might have driven that sort of very exponential gold price increase over that period of time. So this would be exactly how a Bitcoin ETF would work. So there'd be an actual portfolio of Bitcoin, and as people buy the ETF and the value of it drives up, institutions will arbitrage that difference in value, which means more funds would go into the ETF to buy more Bitcoin. Okay, so basically it would have to continue buying Bitcoin, and that Bitcoin would essentially be outside of basically be unavailable to the broader Bitcoin market for doing transactions and stuff like that, which means people who use Bitcoin for day-to-day transactions will have to pay more for the Bitcoin that they need. So the value of Bitcoin will essentially go up because there'd be a huge increase in demand for Bitcoin and a shrinking supply of Bitcoin available to purchase because a lot of it's being locked up by the ETF portfolio. So a lot of people would expect, oh, that's going to cause the price of Bitcoin to go up a whole lot. Now, this is exactly the kind of reason that scares the SEC, okay, the Securities Exchange Commission, because they have to approve of creating such an investment asset in the US. And their concern is that liquidity for Bitcoin, meaning the ability to buy and sell it without having a huge impact on the price, isn't there yet. So the idea is basically if a lot of people buy a Bitcoin ETF, that can quickly drive the Bitcoin price up too quickly, which can then, drive sort of a speculative bubble on that ETF, driving that price up. And then when people cash out, because there isn't the liquidity, the first people who cash out are going to drop the price fairly quickly. And that's going to cause sort of a rush out the door, and whoever's the last one there is just going to be kind of left holding the bag. The idea is that the price is too sensitive to even to new buyers, new sellers. There isn't sort of enough consistent buyers and sellers and a girth of buyers and sellers that, people buying in and out of an ETF wouldn't constantly be having a huge impact on the market price. And that scares the SEC. Okay, because by creating an ETF, they're going to make Bitcoin much more accessible to the average investor. So that may be who more than likely will be sort of that last person holding the bag, because oftentimes the smart money jumps in first and the smart money jumps out first. Okay, so if prices move very quickly, it's just going to mean there's less time for that retail ma and pa investor to really kind of get out in time or get in time. To capture these benefits. They're essentially just providing liquidity to the smart money in a sense. That's the fear of the Securities Exchange Commission, which is a reasonable fear. Okay, and I mean, this could essentially be the situation with kind of any asset you can think of. But the idea is Bitcoin adoption isn't necessarily at the point where you necessarily have the same level of buyers and sellers as, let's say, gold and other securities. So that's sort of the big concern, and that would be an even larger concern with any other cryptocurrency, as they're less liquid than Bitcoin. Bitcoin being sort of the largest, the elephant in the room when it comes to crypto. So that's why the SEC is pushing it back against the idea of an ETF for Bitcoin. Doesn't necessarily mean they're completely against it, although there was like a dissenting opinion of people who are making these decisions who were concerned about maybe they're being too critical, too strict on at what point can you create a Bitcoin ETF, because Bitcoin has become more liquid over the years. But again, it's a fragmented market but that doesn't necessarily matter so much either, because people arbitrage the value between markets, so that liquidity is kind of everywhere, even though it's separate. Not to get too far off the beaten track, but the difference is that the accessibility to that liquidity would be limited for a US-based ETF, because they would only be able to use sort of US sanctioned venues that go through the proper regulations, like know your customer rules, stuff like that. So that means exchanges that don't have these kind of regulations in place and these kind of regulatory practices in place won't be able to provide their liquidity to that ETF. So that ETF would have only a fraction of the actual liquidity in Bitcoin available to it to cash out investors. So essentially they would have to choose one exchange or one or two exchanges, basically have to dump all their Bitcoin if people liquidate their ETFs there, which could kill the price on those particular exchanges quicker than it is on other exchanges, which can have ramifications for investors across all the different assets. Again, as time goes on, Bitcoin's liquidity and other cryptocurrencies' liquidities will grow as people use them for different things, and eventually probably there will be an ETF. Although, next week what I'm going to do is I'm going to talk about other possible vehicles other than an ETF to create a product to give investors exposure to the price of Bitcoin, some of which already exist. So I will talk about that next week. I'll see you guys then. Have a great day. My name is Alex Merced, and you listen to the Bitcoin Crypto Blockchain Podcast. If you like what you're hearing, go over to bitcoinblockchaincrypto.com and tell your friends to go so they can learn about crypto. There's a bunch of videos kind of giving them the basics and the rundown so they can go from zero to hero real quick. And also, if you like what I'm doing, so that way I can do more of it, please become a patron over there at patreon.com/Alex Merced. Have a great day and enjoy.